day, everyone. So, we are the group 2 and we'll be discussing on financial and non-financial performance measures, which is the chapter 15. So, one of the most critical responsibilities in modern business management is ensuring that every part of the organization is working toward the same strategic goals. A key tool for achieving this alignment is the use of performance measurement systems. So, this is the process of collecting, analyzing, and using data to evaluate how well managers, employees, and business units are performing. So, both in the short term and in the long term. So, performance measures allow organizations to assess actual performance against pre established goals or benchmarks as outlined in budgets, strategic plans, and company objectives. So, the primary purpose of management control systems, especially in the area of strategic performance measure, is not simply to monitor but also to motivate and guide. When performance is evaluated effectively, organizations are able to first is to motivate managers to apply high effort. Second is to guide decision making to align with company goals. And third is to establish a basis for fair and objective compensation. So, for these reasons, both financial and non financial performance measures are essential components of any strong management control system. To be fully effective, these measures are essential these measures must be designed to motivate not only top management but also employees and middle managers to act in alignment with organizational objectives. So, the information used in performance evaluation systems generally falls into two categories, financial and non-financial. So, let's define first what is a financial performance measures. So, it allows businesses to assess the economic results of their operations. These measures are quantitative and usually derived from the company's accounting and financial reporting systems. So, typical financial performance measures include first is the return on investment or the ROI. It measures the profitability of a subunit or the company relative to the total investment used to generate income. Second is the residual income or RI, which assesses how much operating income exceeds the required minimum return on invested assets. Third is the economic value added or EVA, which determines the true economic profit by subtracting the cost of capital from the after-tax operating income. And last is the return on sales or ROS. So it measures the efficiency of converting sales revenue into operating profits. Now let us discuss next is the non-financial performance, which measures are equally important as they reflect aspects of business performance that financial measures may not capture. So this include factors that contribute to long-term success, such as efficiency, customer satisfaction, innovation, and quality. So the examples include first is internal non-financial measures, which are manufacturing lead time, the production velocity, defect rates, and number of patents filed or granted. And next is the external non-financial measures, which are the customer satisfaction levels, market share growth, and the customer retention rate. So non-financial measures are often used together with financial data to offer a more complete and balanced view of performance. Now, a popular approach that integrates financial and non-financial measures is the balanced scorecard. Different organizations design their scorecards according to their unique strategic goals, but most scorecards focus on four common categories. First is the profitability measures, which are the financial outcomes like ROI, the RI, or EVA. Second is the customer satisfaction measures. which are the loyalty, satisfaction ratings, and retention. Third is the internal measures of efficiency, quality, and time. These are the defect rates, production speed, or waste reduction. And then the fourth one is the innovation measures. These are the new products, new patents, research and development success. So this balanced approach ensures that organizations focus on both short-term performance and long-term capabilities. Now, the design of a performance measurement system, especially when based on accounting data, follows a systematic approach. So, the following steps are typically followed. So, step 1 is choosing performance measures. So, selecting the right performance measures is crucial. So, it measures must directly reflect the organization's financial goals and strategic priorities. So, the most common measures include the ROI. So, it measures how effectively a subunit or the company as a whole turns its assets into profits. So, the calculation for this is broken down into ROI equals investment turnover times the return on sales. Now, next is to compute the residual income. So, the formula for this is RI equals income minus the required rate of return times investment. Next is the economic value added or EVA, which can be refines the concept of residual income by using after-tax operating income and the weighted average cost of capital to determine whether a company is truly generating shareholder value. Now last is the return on sales. So this is the ratio of operating income to total sales. ROS is equal to operating income divided by the sales. So it tells how much profit is generated from each peso of sales. Now, step 2, choosing the time horizon of the performance measures. Another important decision is to evaluate the performance measures of this step. Should the performance be judged over 1 year or over several years? So, the ROI, RI, EVA, and ROS are usually calculated on an annual basis, but short-term data alone can be misleading and may even encourage managers to prioritize short-term gains at the expense of long-term stability and growth. So, a multi-year approach is often more suitable for the following reasons. First is it avoids short-term distortions. Performance measured in just 1 year may not reflect the long-term success of strategic decisions. Managers might avoid valuable long-term projects if they negatively affect short-term numbers. Second is delayed benefits of investment. So investments such as opening a new facility or launching a new product may initially reduce profitability only to pay off significantly in later periods. Third is alignment with investment appraisal methods. So if companies use long-term investment appraisal techniques like net present value or NPV, then performance measurement should also cover multiple years to ensure their goals remained aligned with the company's long-term objective. Now last is, I know, the step 3, choosing alternative definitions for investment. When calculating measures like ROI or RI, the definition of investment is a key factor. Different definitions will produce different results, and companies select the one that best reflects managerial control and strategic intent. So, common definitions include total assets available, total assets employed minus current liabilities, and shareholders' equity. So, in most organizations, the total asset available is the most commonly used definition of investment when calculating ROI and RI. This is because it provides a straightforward and transparent view of asset utilization, encourages managers to make efficient use of all resources under their control, and simplifies comparison across subunits and reporting periods. And that's all with my part, and my group will further discuss the following steps. Thank you.
So now we'll be discussing the step 4 which it is the topic we're evaluating the performance of business units or investments. Companies move through several steps. So in this step, no, companies usually use total assets available as the basis for defining investment. But here's the catch. How you measure those assets can significantly impact your performance evaluations. Specifically, metrics like ROI or the return on investment and the RI, which is the residual income. So two main measurement alternatives. So first is the current cost. If you mean current cost, this method values assets based on their current worth, meaning what it would cost to replace them or settle obligations right now. So there are two ways to look at this. First is the cash amount needed today to acquire the same or an equivalent assets. Next is the B, which the cash needed today to settle a liability or obligation. Second is that the historical cost. If you mean historical cost, this method values assets based on what they cost at the time they were acquired. Again, 2K perspectives no in historical cost. First is the asset are recorded based on what was paid or the fair value given at the purchase. Next is liabilities are recorded based on what was received or expected payments under normal business conditions. So why it matters, the current cost versus the historical cost. So if you mean ROI and RI results differ depending on which cost basis you use. So current cost ROI gives a more accurate picture of the current economic return, but it can be harder to calculate. So why? Because it involves estimating today's asset value, including things like technological advancements. Historical costs ROI is simpler to compute but can be misleading, especially when comparing old versus new assets. So the problem with historical costs is that imagine two business units. One has old assets, heavily depreciated, low book value, and then one was has new assets, high book value. So if we use historical costs, the unit with older asset will appear to have a much better return on investment, not because of it performs better, but because the assets cost less years ago. So this creates an unfair comparison and doesn't reflect real economic performance. So the advantages of current values, no, it helps make the performance results fairer and more comparable, allows ROI and RI to reflect both the manager's performance, the economic performance of the unit. So makes result more relevant and realistic, especially over time and across different asset ages. So next we'll be discussing the step 5 and 6 in performance measurement. So if you mean gross or net book value for long-term assets, so it is another big question in measuring investment is whether to use. First is the gross book value, which is the original cost of long-term assets. It is before depreciation, or the net book value, which is the original cost minus accumulated depreciation. So advantages of using net book value or the NBV. So first is the consistency with financial statements. So the NBV matches what's shown on the balance sheet, easier to compare with other companies using standard external reporting. Second is that matches the income in ROI calculations, since ROI equals the income or the investment and income already deducts depreciation using the NBV aligns both top and bottom of the formula. So what are the disadvantages? Disadvantages of using net book value. So as assets get older and depreciate, the NBV gets smaller. So ROI looks better over time, even if performance hasn't changed. Depreciation methods like straight line or decline balance are somewhat arbitrary. So these accounting choices shouldn't overly influence performance evaluations. So the advantages of using gross book value, the GBV, because we're done in the NBV now. So first is that avoids the depreciation distortion. So this means no that it keeps ROI and the residual income stable over time. So no artificial inflation, ROI due to aging assets. Next is that less influence from depreciation methods. So by ignoring depreciation, ROI reflects operating efficiency, not accounting choices. So in the step 5 now, we will be discussing the choosing target levels of performance. So once we know how we're measuring performance in ROI, RI, and EVA, we need to decide what good performance actually looks like. So this means setting targets. So first is to adjust targets for context. If ROI is inflated due to old depreciated assets, we should set higher ROI targets for those units. Next is that focus on what's achievable. So if you mean focus on what's achievable, no, means don't worry too much about which cost base. So these are historical or current you use. Just ensure targets reflect what's attainable in the next budget period. Next is the encourage continuous improvement. So instead of aiming for fixed numbers, aim for year-to-year improvements. Example with AVA, which is the economic value added, looks at whether EVA increases each year, not just the total amount. So now let's move on to the step 6, choosing the timing of feedback. So even the best measures are useless if the results come in too late. Timing matters. So key factors when choosing timing. First is how critical is the info. Next is that what level of management is receiving it. So in receiving it, so there is the lower level managers. So these are need more frequent feedback. And then the next one is the top execs, which they can manage with less frequent updates. Next is how advanced is the company's IT. So real-time systems, which means faster, more automated feedback and strategic feedback. So the big picture, which the helps managers see if strategy is working. So if not, it could be because first is that the strategy is fine but poorly implemented. Next is the strategy itself is flawed. So timely feedback can help catch this early and allow for corrective actions. So that's all for my part. No, I hope you learned something and sorry for the inconvenience because I have a fever and uh, I have a dry cough and I cannot pronounce clearly those words. And thank you so much.
So now let us proceed to the performance measurement in multinational companies. So multinational companies are businesses that operate in more than one country. So these companies may have branches or divisions in foreign countries, and this create unique challenges, especially when it comes to evaluating performance. Unlike the domestic companies, multinationals must deal with different environmental factors such as economic factors like inflation, taxes, and currency restrictions. Another one is the legal and political differences, such as government control and also the political stability. Next is we have the educational levels like literacy rates and also the technical skills, and cultural and social attitudes such as work ethics and respect for authority. All these factors can affect how well a manager or a division performs, and this makes it difficult to compare performance across countries. So we have challenges in measuring performance, and here are the 5 key challenges in evaluating the performance of foreign divisions. So first is we have the legal, political, economic, and cultural differences, which can limit or shape what local managers can do. Second is the fluctuations in exchange rates and also the inflation affect financial results, but these are these are outside the manager's control. And third is the availability and also the cost of labor, materials, and infrastructure can vary widely across countries. And next is the transfer pricing, how a company sets internal prices for goods or services between countries. This is complex due to different tax laws. And next is the import controls and government pricing restrictions may also impact a division's ability to compete or profit. So to measure performance fairly, the companies often use a financial metrics or financial measures like the ROI or the return on investment, and also the EVA or the economic value added. However, these focus on short-term results. That's why the non-financial measures like market share, employee turnover, and customer feedback should also be considered for a more balanced view. So now let's take an example of the computations of foreign divisions ROI and the foreign currency. So when Philippines invested or when Phils invested in a hotel in Guam on December 31, 2023, so the investment cost was 55 million pesos. And in 2024, the hotel earned a 10 million pesos in operating income. Now, we'll compute the ROI or the return on investment. So, in two ways. First is using Philippine pesos or the historical base ROI. So, ROI equals 10 million, or we have the ROI equals the operating income divided by investment. So ROI equals 10 million pesos, which is the operating income, and then we have to divide it into 55 million pesos. Then we will get the 0.1818 or 18.2% return on investment. Next is the using US dollars or the adjusted for exchange rate. So exchange rate in on December 31, 2023 is $1 equals to 56 pesos. And the average exchange rate during 2024 was $1 equals 55.50 pesos. So convert both operating income and also the investment into dollars. So we have operating income equals the 10 million pesos divided by 55.50. We have the $180,180. So in investment, we have the 55 million pesos divided by 55. Then we will get the $1 million. So now we will compute the ROI. We have ROI equals $180,180 divided by the $1 million. We have then the 18.2% 0.02%. So this second method adjusts for currency fluctuations, and by doing so gives a clearer picture of actual performance.
So good day everyone. So I will be discussing about the distinguishing performance of managers from performance of organization units. So performance evaluation is performed at different levels in the firm. Top management, middle management, and operating level of individual employees such as production and sales. It is important that performance evaluation of a manager should be distinguished from the performance evaluation of that manager's subunit such as division of subsidiary of a company. So, in evaluating the performance of a manager, separate from the performance of their unit, the following should be considered. So, controllability principle. So, a manager should only be held accountable for the results they can control. For instance, external factors such as inflation, economic downturns, supply chains, disruption of or government regulation can negatively impact a unit performance without reflecting the manager's true capabilities. Next is effort and decision qualities. The quality of decision made by the manager's effort, leadership, and initiative should be assessed even if the unit wasn't shown improved results yet. A manager implementing strong strategies and fostering a positive work environment might be laying the groundwork for future success. Third is historical and benchmark comparison. The current performance should be evaluated in light of historical performance and compared with similar units under similar conditions. If a manager has improved the situation relative to past performance or industry average, this is a sign of effective management. Next is time horizon. Some strategic challenges takes time to reflect in financial performance. Managers assigned to turn around a struggling unit may need several years to achieve results. Interim performance matrix should account for this long-term perspective. Next is being innovative and process improvement. Contribution of innovation, process efficiency, cost control, and employee development are all important indicators of managerial performance, even if they haven't yet result in visible financial gains. And employee morale and retention. A manager's ability to build and retain a skilled team and maintaining high morale is a key performance indicator and can signal strong leadership skills. So by evaluating a manager on this border, more non-set criteria and organization avoids unfair judgment and better identities truly affect leadership. So in evaluating the performance of the manager, this should be given consideration because of uncertainty the manager's environment. The evaluators should recognize that the factors inside and outside the firm also influence the outcomes of the manager's effort and abilities. Therefore, the evaluator should separate the outcome of the manager's action from the effort and decision-making skills improved by the manager. This is separate performance of the managers from performance of the unit or division. So, separate manager from unit performance, managers may face unpredictable internal and external factors beyond their control. Example like market changes, equipment failure, and therefore their personal performance, effort, skills, and decision making should be evaluated separately from overall results of the unit they manage. The evaluator must include only factors that the manager controls. This concept is similar to the first principle, in which it separates the manager from the unit. This second principle excludes known uncontrollable factors from the analysis. Focus only on controllable factors. When evaluating a manager's only considered the factors they directly influence. They exclude uncontrollable elements like economic shifts or company-wide policies to ensure a fair and accurate assessment. So, the third principle is because of uncertainty and lack of observability that the efforts and decisions made by the manager are not observable by top management, a risk-adverse manager is impromptu based to avoid decisions with uncertain outcomes. In contrast, top management would prefer to see some of these relative risky decisions implemented because of top management's greater tolerance of risk. So encouraging balanced risk taking. Since managers' effort and decisions weren't always visible to top management and outcomes are uncertain, risk adverse managers may avoid beneficial but risky decisions. However, top managers with high risk tolerance often prefers this decision for long-term gains. Performance report, combining financial and non-financial results, help bridge this gap, guiding fair compensation and encouraging appropriate risk-taking. So, I hope guys that is clear. So let's us continue to intensity of incentives, financial and non-financial incentives. So management compensation frequently includes incentives tied to performance. The objectives is to encourage goal so that managers will act in the best interest of the firm, arranging therefore managerial compensation to encourage managers to adopt the same goals on the overall firm is an important issue. How large should the intense component of manager's compensation be relative to the salary component? So to answer the question, one has to understand how much the performance measure is affected by actions the manager takes to further the firm's objectives. So, managerial compensation often includes incentives to align manager's goal with the company. Example, goal concurrence. The size of the incentive portion compared to fixed salary depends on how well the manager's action influence measurable performance. If performance measures are highly sensitive to the manager's effort like sales, growth, cost savings, customer satisfaction, the strong incentive-based compensation like bonuses or profit sharing can be used effectively. When such measures are not available or not clearly linked to the manager's actions, companies rely more on fixed salaries, though incentives may still exist in the form of raise or promotion. Non-financial performance measures like employees' morale, process improvement, or customer feedback can also be useful when they reflect a manager's contribution more directly than financial data. In roles where monitoring is difficult, companies tend to increase the incentive portion to motivate effort and good decision making, since direct supervision isn't feasible. So, in short, more companies can measure a manager's impact, the more it can motivate through performance based incentives rather than salary. So, the advantage of using performance measures that are directly affected by managers' effort encourage the use of non financial measures. The salary component of compensation dominates when performance measures are sensitive to managers' action are not available. High salary component, however, does not mean incentives are completely absent. Salary increase and promotion are higher right depends on the overall measure of the performance, but the incentives are less direct. The incentives component of compensation is high when sensitive performance measures are available and when monitoring the employee's efforts is difficult. So that would be all, guys. Thank you.